Welcome to The Explainer. When it comes to investing, your biggest enemy might not be the market, it might actually be your own brain. Today, we're going to dig into why bear markets feel so awful and, more importantly, give you 5 real-world strategies all backed by data to help you keep your cool when every instinct is telling you to panic. So, let me ask you something, and I think every investor knows this feeling. Your portfolio goes up 10%. Feels pretty good, right? But what about when it drops 10%? Ugh, that feels so much worse. And it turns out that's not just you. There is a very real, very powerful psychological reason for this. And you know what? It all goes back to how our brains are wired. Think about it. From an evolutionary standpoint, being super sensitive to threats and potential danger was a fantastic survival tool. It kept us alive. But in the modern world of investing, that same wiring can be a huge, huge trap. This leads us right to this core idea called loss aversion. It was discovered by these 2 brilliant guys, Daniel Kahneman and Amos Tversky, and it's basically the foundation of behavioral finance. All it really says is that we just don't feel gains and losses in the same way. So how much stronger are we talking? Well, it's about twice as strong. The research is pretty clear. The pain you feel from a loss is roughly double the pleasure you get from an equal gain. It's why losing, say, 10 grand can totally wreck your week, but gaining 10 grand, that's just a nice, cool, and then you move on. Now, this intense fear of losing, it's not just a bad feeling. It actually drives us to do things that have a very real and very measurable financial cost, right? When that double whammy of pain kicks in, our gut reaction is to just make it stop, which, of course, leads to panic. And here's the proof in the pudding. A research firm called Dalbar, they've been tracking this stuff for decades. And just look at this gap. Over a 30-year period, the S&P 500 returned over 10.5% a year. The average investor, just over 7%. That's a massive difference. And you know where that gap comes from? Almost entirely from emotional decisions. Buying high because of FOMO, and then, the big one, selling low out of pure fear. So what's the takeaway here? It's that this gap, it's not about being smart. It's not about having some secret formula for picking stocks. The data is screaming at us that the single biggest challenge for most people is just patience. It's having the discipline to stick with your plan when your brain is just yelling at you to do the exact opposite. Okay, so if we know our own instincts can betray us, what do we do about it? How do we fight back? Well, the answer is to flip the script entirely. We need to adopt a different mindset, what's called the contrarian approach. This is all about learning to see that widespread fear in the market not as a danger sign, but as a huge opportunity. And really, who said it better than Warren Buffett? Be fearful when others are greedy and greedy when others are fearful. I mean, it's probably his most famous quote, and for a really good reason. It's just a simple, powerful way to remember to disconnect your choices from what the rest of the herd is feeling. And this really breaks down the 2 mindsets, right? You've got the herd behavior. Everyone chasing the hype, buying high, and then panic selling low. It's all emotion. But then you have contrarian thinking. This is driven by logic, by analysis. A contrarian sees a market panic and thinks, aha, this is my chance to buy great stuff on sale from people who are freaking out. All right, let's get practical now. Because, it's one thing to talk about the theory, but it's a whole other thing to actually put it into practice when things get scary. So let's talk about 5 actual tools for your toolkit, things you can do to build that discipline and patience we keep talking about. So here they are. We're going to walk through these 5 steps one by one. First, zoom out. Then, automate your discipline. After that, systematically rebalance. Number 4 is create a plan. And finally, filter the noise. Think of these as a system you build to protect your portfolio from yourself. First step, zoom out. When the market is dropping and it feels like the world is ending, you've got to force yourself to get some perspective. Just remember that corrections, even bear markets, are a totally normal part of investing. I mean, look at the history. The market came back strong after the 2008 financial crisis. It came back from the COVID crash in 2020. History tells us again and again that patience pays off. And this long-term view, it's your best weapon against short-term panic. Strategy number 2 is to automate your discipline. And the best way to do that is with something called dollar cost averaging, or DCA. It sounds fancy, but it's super simple. It just means you invest the same amount of money on a regular schedule, like every single month, no matter what. This takes the whole impossible game of timing the market off the table. In fact, it actually helps you turn all that volatility into your friend. Let's look at a quick example of how powerful this is. Say you invested a lump sum of $600 back in January when the price was high. By June, you'd be looking at a loss. But what if you invested that same $600 as $100 a month? Well, as the price drops, your $100 automatically buys you more shares. The result? Your average cost per share is lower, and your portfolio is actually in the green by the time things start to turn around. Okay, on to tool number 3, systematic rebalancing. This is such a powerful and totally unemotional way to force yourself to buy low and sell high. All it is the process of checking in on your portfolio every so often and nudging it back to the original mix you decided on. So, for example, let's say you decide on a classic 60-40 portfolio. That's 60% stocks for that long-term growth and 40% bonds to give you some stability. This is your target. This is the plan you made when you were calm, cool, and collected. But then, let's say stocks have a great run. You look at your portfolio and suddenly it's drifted all the way to 75% stocks. Whoa. Now your portfolio is way riskier than you originally planned. Rebalancing just means you sell some of those stocks that did really well, that's your sell high, and you use that money to buy more bonds to get back to your 60-40 target. And of course, in a bear market, it works in reverse, forcing you to buy more stocks when they're on sale. Number 4 is an absolute game changer. Have a written plan. The fancy name for this is an investment policy statement, but really, just think of it as your personal investing rulebook. You write it down when you're feeling calm and rational. You spell out your goals, your strategy, everything. That way, when the storm inevitably hits, you don't have to think, you don't have to panic, you just follow the rules you already made for yourself. And that brings us to our 5th and final strategy. You have got to learn to filter out the noise. I mean, we are just bombarded 24/7 with financial info, right? Breaking news, hot takes on social media, endless speculation. And here's the secret. Most of it is designed to get a reaction out of you, not to actually help you with your long-term plan. So how do you actually do that? You have to be intentional about it. Limit how much financial news you consume. Find just a couple of trusted sources that focus on data, not drama. Pay attention to the fundamentals of the companies you invest in, not the day-to-day headlines. And maybe the most important rule of all, make a pact with yourself to never make a decision right after seeing some breaking news. So when you put all of this together, zooming out, automating your investments, rebalancing, having a plan, filtering the noise, what you realize is that they're all designed to help you build one single, incredibly powerful asset. And funny enough, it has nothing to do with money at all. Here's the bottom line. Long-term investing success has so much more to do with your behavior than with being some kind of genius. It really is about having the discipline to follow a simple, sensible plan over a very long time through all the ups and the downs. That is what separates the most successful investors from everyone else. And that leaves us with one final thought that just perfectly sums all of this up. It's another gem often attributed to Buffett. The stock market is a device for transferring money from the impatient to the patient. Ultimately, it's about staying the course. So the only question left for you is, which side of that transfer are you going to be on?